Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren, and with me here in the studio is my friend and colleague Niklas Sävås. How are you and how was the summer?
Summer was great. I feel really refreshed and had a long, good holiday. Some time in Greece and a lot in Sweden. So it feels great to be here and introduce today's interview.
Not bad. I also had a wonderful summer, a lot of time for reading, some social activities, time in nature, and now it's great to be back. And in this episode of Investing by the Books, we have the pleasure of once again sharing an interview with our friend Christian Billinger in London. And Christian is heading his family office, Billinger Förvaltning, and he has now done a number of episodes on this podcast. The most recent one was episode 55, where he talked to Edward Chancellor about his book Capital Returns. So this time he will speak to Steve Clapham. And Niklas, who is he?
So Steve Clapham is the founder of Behind the Balance Sheet, an investment research and investor training consultancy. He has 25 years experience as an investment analyst and has been a partner and head of research at 2 multi-billion-dollar hedge funds.
And for this episode, the focus is on Steve's book, The Smart Money Method. What is this one about?
So in short, the book outlines Clapham's best methods on how to find stock IDs and beat the market. Peter Harrison, CEO of the $1 trillion asset manager Schroders, describes Steve's book as, quote, an extremely good read for anyone wanting to master the art of stock picking. The author has had an uncanny knack of spotting winners and losers throughout his long career.
The Smart Money Method was published by Harriman House in November 2020, and we are delighted to have its author on the show today. Here comes our conversation with Steve Clapham.
Well, welcome on the show, Steve. Great to have you on.
Oh, thank you for having me. I'm looking forward to it.
Likewise. So we've met on a few occasions, haven't we, over the last year or two in Omaha and at the London Value Investor Conference, and we had dinner together last night with a few other investors in London. And so we wanted to have you on the show and discuss, partly discuss the book you wrote, which is this one here, the Smart Money Method, and also to discuss your career, the different roles you've been in, sell side, buy side, and also your current venture in terms of training, I guess, the next generation of analysts and PMs. So maybe as an intro, Steve, could you just give us a sense of why the interest in investing? Because I think, like me, your background wasn't an obvious choice, so to speak.
No, I mean, I didn't have any interest in investing. I ended up in investing, completely by accident. Yeah. It was a very, serendipitous thing. I'd applied for a job in industry, and I was interviewed by the CFO of the fifth largest company in the UK, and I was going to be reporting to somebody that reported to him. So I was two off the CFO. It was a real high-flying role, and I was quite excited about it. And then the guy, my new boss to be, called me up and he said, "Oh, Steve, the personnel department pointed out we made a bit of a mistake." Excuse me? He said, "Well, thing is that you're too young to be this grade. So we're looking forward to having you. You'll still be doing the same job, but you'll get 5% less money." And I said, "I'm sorry, look, to be honest, I don't want to work for a company where your progress is determined by your age rather than by your talent. So thanks very much, but I'm not joining." And I was telling the story to my brother-in-law, and I said, I'm sure I've done the right thing, because it just didn't feel right to go and work for this group. And I just felt I'd always be kind of irritated. I'd start a job and I wasn't, I would have been annoyed about it. But I said, I don't really know what I'm going to do. And he said, "Well, have you thought of going into the city?" And I said, "Don't be stupid. How would I do that?" And he said, "Well, these jobs as an analyst, I think that would be quite good for you. I think you'd quite enjoy that." And I said, "Well, what's an analyst? What do you do?" Well, he said, to be honest, I'm not really too sure. But my secretary, her partner, works at one of these firms. Why don't I call her up and see if he'll have a coffee with you? And say, oh, you think you'd not mind? And she thinks she'll not mind. Do you think he'll not mind? Well, look, I'll go. And he called her, and the guy said, fine, tell him to come in at next Tuesday at 8:30. So I rocked up to this stockbrokers. I didn't even know what it was, right? I mean, and I went in. I'd taken my CV with me because I just thought, well, and I went in, and the guy explained what an analyst did, and it sounded quite interesting. I gave him my CV, and he said, "Oh, come and work for us." And excuse me? And he said, "Yeah, we're looking for talent. You seem like you're quite smart, and just come and see my number two, because he'll be who you're reporting to." Went to see the number two the following week. He said, "Yeah, we're looking forward to having you." And so I went in, and honestly, I mean, I couldn't spell PE. I mean, that's how much I knew. I didn't know how to cut. I didn't know what a price earnings ratio was. I remember thinking, oh, I better start reading the Financial Times. And it took me about 3 months before I could understand even one of the elements of the Lex column. I mean, it was just gibberish. I was clueless. But I got on really well then because I was trained as an accountant, so I could understand numbers, and because I completely outworked everybody else. Because they were all, the guy I sat next to used to complain because he said, I used to come in at 9:30, go for lunch, long lunch, and go home at 4:30. Now the morning meeting's at 8:30. And I said, Bob, I've just come from a job where, one day a week I was in Leicester, and I started at 8 o'clock in Leicester. So I left the house at 6:30. I got home at 8 o'clock at night. That's what people do in the real world.
Yeah. That was I think you're also describing the city of old, right? I saw some of that even when I started 20 years ago, but it's obviously changed. But you were on the sell side, Steve, and then you were on the buy side, and then obviously we'll get on to what you're doing currently. But it was interesting because I think in the acknowledgements, I think you say that the best job you had was at Tosca Fund. Could you just elaborate on why, what you did there and why you enjoyed it so much?
Well, I'd never really had any aspirations to be an investor, because I was a stockbroker. I was looking at stocks. I was a sell side analyst, and I really enjoyed the analysis. And I was offered a job by Stuart Newton, the founder of Newton Investment Management. But he said, I'm not sure whether you'll be an analyst or a PM. And what we do is we have you interviewed by a psychologist to decide what you'd be best suited for. And I said, so, that's not my decision. And he said, well, if the psychologist says you're an analyst, you can be an analyst. And if he says you're a PM, we want you to be a PM. And I didn't really fancy doing it. But then Martin Hughes, the founder of Tosca Fund, he had been the banks analyst at Tiger, and he was a client of mine. And, I'd gone in and given various bits of advice to them. And then he just called me up and he said, come round today because I need to see you about something. And I said, Martin, I've been round to see you not that long ago. I don't have anything new to say. He said, just turn up. And so I turned up, and he said, right, you come and work for me. And I thought, well, this is at the time, it was the largest financials hedge fund in the world, and I was recruited to do the non-financial stuff. And I'd never really sort of thought about, what you did, what my clients did. I was helping them invest, but I never really thought about how you did the job. And I was a generalist doing global equities. So basically, I could buy or sell any stock that I wanted to. So I could go anywhere in the world to find a good idea. And it just was fascinating because, I had all the brokers, desperate to help me. Whereas before, I'd gone from, being very, very focused on a small number of stocks, knowing them very well, without any real assistance, to having, I could call up any analyst anywhere, and say, I'm looking at XYZ stock. Can you send me your model? And I had all this resource to help, and I had this huge, wide field. And you'd have had to have been an idiot not to find that more stimulating, more interesting. And I mean, it was never easy, right? Investing is never easy. But when you're just trying to find a few stocks and you got the world to choose from, it's not that difficult when you've got every broker, to help you to find a few good ideas. And we weren't trying to find hundreds of good ideas. We weren't trying to trade. We're trying to find long-term, fundamental, mispriced situations. And it was fascinating because I was learning about all these new industries I'd never looked at before. So, at heart, I'm an analyst. So the opportunity to learn was phenomenal.
And just a quick word on the industry, because there's a section where you talk about company trips, right, and all the sort of fun and weird experiences you've had during those. But in some ways, even if I look back to when I started in the industry, it seems in many ways in some ways at least, it's a less fun and less colorful environment. I mean, did you perceive that through your sort of time in the industry, that it became more, not just more highly regulated, but also that the sort of personality set changed a bit?
Well, I think it depends on you, and it depends on where you're working. I mean, when I started, I remember the head of the box. So we were organized by industry grouping, and I was in the capital goods area. And so the guy who was the number one engineering analyst was head of the box, and two of us had joined. And we'd been there 3 or 4 weeks, and he said, "Oh, we better go out for lunch, and I'll tell you, show you the ropes, tell you what to do." And so we went to the Bunghole, which is a wine bar in Holborn, and he ordered 3 rounds of roast beef sandwiches, and then he ordered 3 bottles of claret, one after the other, and that was quite, that was quite normal, and did less of that progressively over time. But and obviously, you're there to do a job, you're there to make money, and you want to be focused. But we would go out for lunch. Every place I've been, we would always go out for lunch with your colleagues. Not every day, but once a week or once every 2 weeks, and occasionally go out with a broker. And we weren't, if you're 100% focused on work, and I think a lot of institutions are like this today, they've got no relaxation time, they've got no space. If you switch off, that's when you get your best ideas, right? If you're sitting there in front of spreadsheets all day long, you never have a good idea. You need to stand back. And it's funny, I was walking back through Hyde Park. I'd been in Knightsbridge for something, and I thought, rather than take the tube or jumping about, I'm just going to walk back. Such a nice day, and I didn't put my headphones in. Normally, I listen to a lot of podcasts, but it was just a nice day, and I just started walking, and I just came up with the solution to a problem in my business, not thinking about it. And I'd taken a half hour, which I wouldn't ordinarily have taken. If I'd been working at fund, I would have been straight on the tube or straight in a cab and not wanted to waste any time. But by wasting the time, I got the inspiration. And it was a great lesson to me, because I'd always been, trying to get the most out of the day. And actually, sometimes it's very good to switch off.
No, I agree, and also for the relationship building, right? Like we experienced last night. I mean, that's such an important part of it, which I think certainly I saw much less of when I worked at a large fund as well. So I agree with you there. Look, maybe if we could spend a bit of time on your investment philosophy and style, Steve. And obviously, this relates to many of the topics you cover in the book, The Smart Money Method. So one interesting sort of point was that you say a good investment is any stock which beats the market over a short or long period. And I think you also say it should have an upside of 50% or more over 18 to 30 months. Is that still the filter you would apply to sort of, would that still be the hurdle rate?
Yeah, I mean, you have to remember I was doing special situations. So I was trying to find, a few stocks that were going to be really good. And I mean, now, when I'm investing myself, I'm more interested in sort of asymmetric bets, things with not much downside. And if they've got, I'm looking at something at the moment that's I started buying it. It was a 30% discount to NAV, and it's now a 20% discount, and it hasn't gone up that much. But if I can make 15 or 20% in 3 months, well, those situations don't come up all the time, but I'm quite happy to do that. But I think if I'm looking for a long-term fundamental investment, I'm trying to find something that will either, I can buy and own for a long time. I'm more into that sort of quality investing, your kind of area now. But when I was a professional investor, I was simply trying to find things that were very mispriced and own them for as long as it took for that price anomaly to be corrected. And if you don't think of, like something, if you don't think that something can be 50% more expensive, then if you're going to spend, and I spent a lot of time looking at individual stock, because you don't get them all right. So, if you don't go for that, it's hard to make much money. I mean, we had stocks that we owned for a very long time at various funds, because if you buy something, you think it's 50% the wrong price. Inevitably, that's because of some either fundamental changing or the market's perception changing. And usually, if it goes up 50%, it will go up a lot more.
Yeah. And when you say special situations, Steve, how would you define that? What kind of types of investments would you include under that?
Well, I mean, we never did too much in the way of sort of non-equity investments. I mean, various funds we did straight outside, but I would define that as, we might buy a debt instrument which was completely mispriced or something like that. But generally, the way I define it is something with something peculiar about it that makes it very cheap. And it might not be, it can be a straightforward equity, it can be a S&P 500 stock, but there's something funny about it that's caused the mispricing. Because I hate the word catalyst, because I was like, oh, there's going to be a catalyst, and I always think that's kind of difficult, because if you buy things that you think are very cheap, and the catalyst may not necessarily be obvious, it's just something that you've seen that's changing, some internal thing within the company or some external thing in the environment that's going to cause its profitability to go through a change. Usually that change will be recognized as the profits come through. And so, I'm not one of these people that say, oh, you've got to have a catalyst, because the catalyst is, for my process, is really about companies whose profitability has been incorrectly estimated by the market. It can be on the upside or the downside. But usually, we're talking about longs. There's something changing in the environment, which means the company's going to be more profitable than people think. And that's my favorite kind of thing to go for, because it's something that I can use my skills to feel confident about. So I can have a high degree of confidence that this is going to happen. And if the profits change, the share price will usually follow.
Yeah. And I get the impression when I read the book that you certainly, when you worked in the institutional world, you spent more time thinking about earnings surprises or earnings momentum than thinking about traditional sort of deep value as such. Is that fair?
Yeah, I mean, I'm not a big valuation person. The idea of you buying a stock in 15 times because it's normally on 16 and a half times. I think that's a complete waste of energy, because usually the stock market knows that it's on 15 times, not 16 and a half, and there's usually a pretty good reason for it. So, that kind of, companies change over time. The market's perception of companies changes over time. So my focus is really on the company's profitability. Look, everybody invests in a different way. I'm not saying that this is what people should do. I'm just saying, for me, that's what I learned to do, because that's how I found I could make the most amount of money most reliably with the least amount of distress.
But that would look different today, then, would it? As if you compare the way you invest today with, when you worked, say, at Tosca Fund or any of the other funds you were at. So you invest in a slightly different fashion today. Is that right? Is it more of traditional sort of buy and hold investing, so to speak?
Well, I don't have the luxury of the information that I used to have. And I'm not doing it as a full-time occupation. I probably should spend more time than I do investing. I think I'm going to change my schedule. But if you're working, you're arriving at 7:15 in the morning every morning and leaving at 6 o'clock at night every night, and reading, taking stuff home to read it on the way home, or read it the weekend, you're consuming a vast amount of information, and you're very aware of what's going on all the time. So you're very alert to changes. So it's much easier to find opportunities. Whereas if, like for me, I'm not going to sit this afternoon when we finish our call. I'm not going to go and look at the share prices in the stock market. It's not something that I need to worry about overly. So, I don't do as much monitoring of prices and news and events as you do when you're full-time working. So there's fewer ideas. So therefore, by definition, you kind of got to hold on to things for longer. I mean, it's just really a time thing. If I had more time, even if I had more time, I doubt I would, be as active as I would be as a professional investor, because I don't have the information flow. And, a large part of my process is about understanding why the share is priced the way it is.
Yeah. One of the items you talk about, let's call them checklist items. You talk about capacity entering and exiting an industry. So I spoke to, we spoke about the capital returns book with Ed Chancellor a while ago on the podcast. Would you consider yourself a capital cyclist? Was that an important part of figuring out the earnings surprises and the earnings momentum?
Well, I was always a proponent of a capital cycle, even before I read Capital Account. I mean, I don't know when they published that book, but I started looking at the transport industry a long, long time ago. And in the transport industry, the marginal change in supply is very, very important, because once you get, you follow the airline industry, and once there's a load of capacity arriving in the winter and demand's a bit soft, pricing goes through the floor and the earnings go through the floor. So you learn to be acutely aware of that. And of course, you will be very familiar with the shipping sector. It's exactly the same thing. And there's lots of ways of tracking the order books and so on. And so that that discipline was something that, when I started on the buy side, I was very conscious of, because I knew that changes in capacity, changes in the supply dynamics of an industry were important. And of course, the beauty of that is that it's much easier to track. Right? Lots of industries, you can see how much capacity is arriving. You're much less certain about the demand profile. But the one thing is, if there's a load of capacity arriving, then that's probably not great news. And then, what was it the other day? It was that Shell had stopped construction of a biofuels plant and in Europe. And when I see that, I think, oh, that's quite interesting, because companies rarely do things like that. And when you see that sort of capacity discipline emerging, that there's going to be a change in the pricing dynamics some way down the line. So it's a very reliable indicator. It's not something that I would go necessarily make a central part of my process, but I'm very very alert to that sort of thing. So if I'd been a fund when I saw that notification, I'd immediately look and see how those stocks were priced, and see, and then I would add one of those stocks to my watch list, or two of those stocks to my watch list, and say, okay, well, let's just watch what's happening in this industry, because maybe there's going to be an opportunity down the road.
Yeah. Yeah. Okay. I mean, it sounds like you'd use it as some sort of overlay on much of the other work you did.
Or it can be a standalone source of ideas, but it's only one tool in the toolbox, because they don't, those opportunities, they don't come along every day. So you when you see one, you want to jump on it, but it's not kind of like a precondition to buy a stock. It doesn't, but it's definitely something that I would be very aware of.
Yeah. So one interesting point you make in the book is that you say, or you claim, that investing with crooks can be highly profitable, Steve, which I thought was one. It's quite sort of it's an unusual thing to hear, but I thought it's also interesting because you provide a few examples in the book. Can you think of any current example? You may not, but if you can, do you have any examples in the current environment?
It's not something I've done recently.
Yeah.
Just the people, institutional investors tend to be quite careful, cautious people. So if they feel that they don't trust a management, that is kind of the worst possible thing. And so you get these people that, sometimes it's right, and very occasionally it's not. And obviously it's dangerous investing with crooks, because you can be defrauded. But if you are investing with somebody who's got crooks is probably the wrong word, but somebody with a checkered record, and they've been, they've done something wrong in the past, and they've realized the folly, the error of their ways, and they've rectified it, they've corrected it, and they're now on the straight and narrow, but they've still got that besmirched reputation overhanging them and causing a discount in the share price. Well, if I'm confident that the business is a good business, if I'm confident that they're kind of going to be on my side and straight from now on, well, that can be a good opportunity, because over time, the bad behavior gets more and more distant in the past, and people have got short memories as well in the stock market. So I'm always looking for that. I'm going to get a bit extra on the earnings and a bit extra on the rating.
Yes.
Because that gives you much more leverage in the share price.
Yeah. That's great. Thank you, Steve. So that's certainly a few aspects of this philosophy and style you describe in the book. So in terms of process, one thing I wanted to ask you is, the extent to which the industry has changed, certainly since you started working on the sell side, and in terms of, I guess, the tools and the techniques, and this also relates to your training business, if that's the right word. What kind of things would you be teaching young analysts today that perhaps weren't as relevant when you first started, Steve? What has been the big sort of developments there?
Well, I mean, obviously there's a much greater use of technology, and everybody knows how to do a spreadsheet, which wasn't necessarily true when I started. So there's a much greater use of technology. But I think that one of the big changes is over time, there's a lot more information being developed. So I did an exercise for one of the Sunday papers in the UK. They were celebrating their 50th anniversary, and they asked me to look at a set of accounts from 50 years ago. And we struggled to find a set of public company accounts from 50 years ago. And the one thing they could find was, I think it was the Midland Bank, and it's now HSBC. And the Midland Bank's accounts from 50 years ago were basically a balance sheet and, a few notes. It was like 8 pages long. And HSBC's accounts that year were 520 pages long. And they also published 3 other massive sets of accounts. And at that, just the sheer volume of information that you've got to cover makes it a lot more time, effort, sensitive. So, what's very difficult, I think, when you're a professional analyst is you find that you've got an idea, you start to investigate it, and then you get a certain amount in and you think this isn't a good idea, and you've got to dump all that investment of time and energy. And people are reluctant to do that, right? Because I know obviously you don't necessarily need to do it, because you just say, well, I've done this work. I know if this share price comes back again, then I know I can press the button. But it's quite difficult. I think people often pursue things even though they probably shouldn't, because they're not as confident about the upside, but they feel they've invested all this time and they don't have anything to show for it. It's bad. And so I think one of the key things to think about, and what I teach people in the training, is go for the easy wins. I think a great mistake investors make is they like complexity. They like to say, "Oh, I'm really clever and I've solved this really intricate puzzle." And Warren Buffett tells you that you look for 1-foot bars that you can step over. So I think that the way I used to think about it was return on time. So you're obviously trying to make the most amount of money, and you're trying to make invest the least amount of time in order to do that. So I'm not saying cut corners or don't do the work, but I'm saying find easier things to buy, easier things to sell, where you need to do less work. Obviously, it's become a much, much more competitive industry. So when I started in the buy side, there were, it didn't seem it at the time, but it was actually a much easier job because there was much less competition, far fewer hedge funds, far fewer global investors. Being a global investor in even just before the global financial crisis, being a global investor gave you a huge advantage, right? Because other people weren't doing that. Today, I would say the majority of my clients are global investors.
Yeah. But it sounds like in terms of training or sort of preparing young analysts these days for their careers in the industry, it sounds like it's not just about developing the tools, right? The sort of analytical tools, but it's also teaching them in a way, or coaching them or mentoring them how to manage their workload and how to prioritize what kind of things to look at and all these things.
Yeah, I don't do young analysts so much.
Okay.
I've got 2 or 3 clients where, I've got long-standing relationship with them, where I've been, my main product is my forensic accounting course, and the forensic accounting course is for experienced analysts. So, if you're a graduate trainee, it's pointless doing that course because you just don't, a lot of it will go over your head because these are very complex, things to look at, second or third level. But I've got some clients I've got a couple of clients that are growing, and they're taking on people with 2 or 3 years experience. And so they might be poaching somebody from a Fidelity or a BlackRock or another big institution. And these people have all got different levels of experience and also different levels of training. And so what we do is we help them, help ensure that they all reach a minimum standard. They're all good people because these are very successful funds, and they're inundated with offers of help from young analysts wanting a job there. And so the people are by nature very, very talented, but they may not know everything. They may not, or they may have had, emphasis at different training. So, what I do is I'll train them in, some basic stuff. And, how do you build a 3-statement financial model that's robust and, self-error checking and anybody can look at. And I don't do the modeling training. I have a colleague that does that. But and then I go through, how do you process a set of accounts? So how can you do it faster, but not miss anything? And we do also cover some of those sort of aptitude type. How do you manage yourself better? Things like time management, and a lot of them hate this stuff because I say to them, well, how do you, what do you read? And they all read the FT and the Wall Street Journal, but they all read it online. And I'm like, well, actually, that's really stupid. And I go, what do you mean? I said, have you? And I get the physical newspaper, and I say, well, I can read the physical newspaper much quicker than you can read your iPad version because A, it's got less in it, and B, I know that when I go to page 2, I know that where that is, why it's in that position for a particular reason. And so I can see clearly what's important. And so I can read the newspaper much more quickly than you can read your iPad version. And that sounds a bit stupid because how long does it take you to read a newspaper? But reading the newspaper is something that you as an analyst, you have to do every single day. Now, when I was at the hedge funds, I didn't bother reading the FT except, really skimming it quite fast because I was consuming so much information, and the newspaper was yesterday's news, and I wanted today's news. But that sort of thing is extremely valuable in making you more productive. So I try and focus on those sorts of areas where I can help them be more effective.
Yeah. So you say somewhere in the book, Steve, that investing is about exploiting this gap between perception and reality, right? And you first try to understand the market perception, and then you check the reality. Do you have any examples of that, or could you just give us a sense of how you go about those 2 steps, right? So 1, getting the market perception, and 2, checking reality.
Well, I think that the big mistake people make, and a lot of private investors make, is that they think something's cheap, and they don't ask themselves why. And I think that's really silly because if you don't know why, you don't kind of know the other side of the argument. And so I always want to know, what's in the price. I think it's one of the most important things. You're operating in the market, and the market's illogical and gives you opportunities, but you need to understand why you're being presented with the opportunity, because you may have missed something. And I'm paranoid about missing things. And your win rate, your hit rate, whatever you want to call it, is really an important factor in your success, because obviously if you make mistakes, you lose money, and that really detracts from your performance. So how do you ensure? You can't ensure. You obviously still make mistakes, but how do you limit the number of mistakes you make? Well, understanding the downside is one part of that, but understanding why the stock market has mispriced something I think, unless I know that, I won't invest. Because if I don't understand why the thing is this price, I'm worried that I missed something. Now, occasionally you just can't, you can't find out, and it just seems so stupid that you'll buy it anyway. And there are there are occasions where the stock market is just really stupid, and you don't know that there's some big seller, the guy's left. There's some big fund, the guy's been fired or he's gone to another job, and the guy's taken over, started to sell it, and you don't know why that's happening. And then it stops and the thing goes up again. But it's a lot easier if you know that that's what's going on, because then you know that you've got to be quick. So all these things, I think, understanding the perception is almost as important as understanding the reality. And if you haven't sort of got both sides of that, then you're at risk. I mean, it applies less to if you're buying, high quality companies that are delivering high returns, because they tend not to be cheap. But, if you look at a situation, for example, like Diageo today, that's a good example of a stock where you've got a number of moving parts, and there's a lot of confusion, I think, in investors' minds, because I think, who is this woman, the new CEO? Is she any good? She's replacing a guy who was considered a superstar. You've got this timing of COVID. COVID's been, I mean, I've not been a professional investor over that COVID period, but I think it's made it very difficult to understand the actual demand and supply dynamics in the short term. And that's causing a lot of dislocation, or has caused a lot of dislocation. And that has caused some dislocation for Diageo, clearly. And then you've got another sort of secular argument about, do young people drink? And so, you've got quite a lot of moving parts. And I like to try and think through all of that. What's causing that share price to have gone down? And I don't think Diageo's share price has changed since 2019.
Yeah. I've looked at it closely because I've been invested in Diageo for a number of years. And so it's interesting you bring up that example, because I look at the valuation and I try to figure out what are the concerns here, and then of course so effectively the process you're describing, then you just do the reality check and you try and figure out, are actually young consumers drinking less to the extent generally perceived, and all these things, right? The difficulty is with some of these things, especially the big long-term trends, there are no clear answers today, right? We can't have but you can make an educated guess, I guess. That's as close as we can get, right?
Yeah, but I mean, there's two parts of this. So whether young people really aren't drinking or not is one question.
Yeah.
But is that what the stock market is worrying about?
No, of course.
Because if that's what the stock market is worrying about, it might take a decade for that to be proven right or wrong. And so you could end up owning the stock and just having your money sitting dead. And that, those sorts of situations, if I think that is what the market is worrying about, I'm much less likely to invest, even if I have a strong feeling about whether young people are drinking or not. I had 5 young people in my house for the England match, and I can tell you there was a lot of beer consumed before, and even more beer consumed after.
I'm encouraged.
The irony, though, was that it was Spanish beer, which I thought was particularly cruel.
But also, of course, even if you have a view on these, whether, say in this case, if young consumers are drinking less, then you got to figure out, well, even if they were, what is the impact on a business like Diageo? It's an interesting process. I think it's also a good example of, you said often that kind of thinking doesn't apply as well to buy and hold quality type situations. But I guess, companies like Diageo, most would argue are fundamentally very high quality, but we may be seeing it a temporary sort of challenge to their business. Hopefully
they may or may not be
exactly
high quality, because if young people stop drinking,
of course,
then
And there's a number
you
of
need an awful lot of premiumization to make up for
Agreed.
that.
No, I agree. That's the big difficulty to determine that. You talk about in the chapter on quality, Steve. You also touch on the earning cycle, companies over or under earning, which is something I've sort of learned the hard way, certainly in recent years, and I think through COVID and coming out of COVID, to pay very close attention to. I've seen this in some of the companies we've been invested in, like Estee Lauder and others. But could you just give us a couple of things that you would look at high level to get a sense of, is this company over or under earning currently? Are there any things, are there any sort of one or two or three things that you would look at initially to get a sense for that?
Well, I think it's very stock specific.
Yeah.
But I mean, my process is to think about the margins and to look at a long-term chart of margins and just say, okay, well, where are we? And if the thing's been, the margins have been going constantly up, you have to ask yourself, well, how long can that continue? What is the real pricing power and what is the real competitive landscape? If the margins have been up and down over time, that's in a way easier because you can just say, okay, well, that the amplitude of the wave may change, but if it's been a stock that's earned a margin of 5% at the lows, 15% at the highs, and at 10%, I'll usually just say, okay, well, let's just assume that 10% is the earnings power long term, what the sales is going to grow at, what am I prepared to pay, and is it earning more or less than 10% today? And I'll think of it in that sort of dynamic. So if it's got 5% margins today and the P is not that high, and I think the margins are long term about 10%, and I've got the chance that it might go from 5 to 15, then I'll get quite excited about it. If the valuation's not too high, and as long as I assume that it can get back to those sorts of margins, I've got to understand why the margins are down. But that's the kind of thing that I like, because you've got a reasonable probability that things will repeat.
I guess one of the challenges there is, if you look at, say, the long-term margin trajectory of, take a few companies that were invested in the luxury space, for instance, their margins are much higher than they were 5 or 10 or 15 years ago. But then you could argue things, and it's always a dangerous argument to make, but that things have changed, right? That the mix of business and the scale and everything means that structurally margins probably are sustainably higher than they were 10 or 15 years ago. But would you be sort of wary of those kinds of situations, or?
No, I mean, I think luxury is quite a good thing. I mean, there's more rich people in the world, and there's more people on Instagram that want to be showing their latest handbag, and so I kind of don't think that's going to go away. I think the problem in the luxury space is really understanding what is a luxury brand and what is not quite as a luxury a brand. And you look at brands like Ralph Lauren, and you think, well, Ralph Lauren now going up market again. To what degree do they really have pricing power? It's a kind of an old person's brand rather than a young person's brand. Or Burberry. I mean, Burberry is a really interesting situation because, and I'm not, just from looking at me that I'm not a luxury brand consumer, right? But when you see a Burberry, you think, well, hang on a second. I mean, I haven't looked at the stock price today, but I mean, the stock hasn't been doing well. The business hasn't been doing well, but the brand is quite a good brand. And if they can just get their act together, and do people want to own Burberry scarves? I think they do. And it's quite an aspirational item for lots of people. So if they can just work out what they actually stand for, then it could be quite an interesting stock. I mean, I don't think some new CEO coming in very challenging situation and quite a risky situation. And I don't have any particular expertise, but something like Hermes, I mean, there's all sorts of talk about them buying the used Birkins to keep the price up, and I have no idea whether that's true or not. What I do know is that multiple people I know will spend a lot of money in the Hermes shop just to keep themselves in the, yeah, well, I want a new Birkin. And there is no shortage of appetite for Birkin handbags, as far as I can see. And it doesn't seem to matter what the price is.
It's interesting.
And
you mentioned the example of Burberry, Steve. It's interesting because with a big sell-off we've seen there, I'm not invested. I haven't been invested, but it leads me on to another question, which is the idea of, and you write about this in the book, Steve, retesting the hypothesis. I think you say if shares are down more than 20%. I thought it was interesting. I listened to what Julian and Terry Smith said at the Fundsmith meeting this year about Adyen. So last year at the meeting, they said Adyen was probably the one stock they didn't own that they would like to own, but the valuation was excessive, they thought at the time. And then, of course, there was a very big sell-off in Adyen, but they didn't buy into it. And they got the question again this year, why didn't you buy in? And I think Julian said, typically a glitch, as they define it, would see a sell-off of 10 to 20%, say. But he said, I think Adyen shares were down almost 80% from peak to trough. And he said that just made us uncomfortable because we had a sense that something had changed in the business. So I guess my question is, do you sort of share that view? Because you talk about retesting the hypothesis, but you talk about a 20% number, Steve. But is that because at that point you would feel that maybe something has changed here?
Well, I'll come back to the 20%. The Adyen, I don't know. I know so much about it, I don't even know how to say it, but I was asked to look at it actually by a client. So I've got this advanced valuation class, and the advanced valuation class is, all about valuation, not about the theory, but how I do it. And I will look at big positions of the clients and go through use that as a case study, because that's quite helpful, because that they know the company better than I do, and I just explain how I look at it and how I value it. And I was asked to do Adyen, and it was 2021, and I'd looked at this and I just couldn't understand the share price. And I had this wonderful conversation. I was in Lansdown's office. So Lansdown Partners, a long established, used to be, one of the biggest hedge funds in London. My number one client for many years when I was in the South Side. And I was interviewing Pete Davis along with Spencer Crowley, who's one of the founding partners of First Minute Partners, a VC firm. And I had this Adyen job to do, and I'd looked at it and I was very confused. And I texted Mark Rubenstein and said, look, I've got to speak to you about Adyen. He said, oh, I'm in Berkeley Square. And so I said, oh, I'm in Lansdowne. We've just got the podcast. The sound engineer has got all the mics set up. I've got 20 minutes. Have you got 10 minutes to have a quick chat in the street? And ironic, because Mark used to work at Lansdowne, so he knew exactly where it was. So we met, and then Spencer pitched up. And so this is probably September 2021, so very close to the peak. I don't remember what Adyen the price was. And I said to Mark, so, Adyen, what? And he said, well, you shouldn't ask me, because I thought it was expensive a month ago, and it's doubled since then. And Spencer said, oh, Stripe. Rumor is they're coming to the market in February at a $250 billion valuation. And what? And of course, I didn't know any of the numbers of Stripe, but it just seemed like a big price, right? And I said, and he said, well, look, he said, that's the talk. The Stripe's previous valuation had been 96 billion. And I think its last valuation probably 60 odd, if I remember correctly, something of that order of nature. Anyway, so I went back and I did the Adyen valuation. I said, if this stock grows at 40% per annum for the next 15 years. And I said, look, I can't think of a company that's grown at 40% CAGR for 15 years. But, I'm not saying it's impossible, because clearly it's possible. And clearly in that space, payments, global business, they could do that. Then they'll get to this level of sales. And if they maintain their 60% EBITDA margins, then in 2035, the stock will be fair value. And, that didn't sound very bullish to me. It would be, if you owned it and you believed that story, you might wanted to carry on. But, you would be hard pressed to buy more. And any sensible person would say, well, you know what? It's crazy. It could get even crazier, but I'm at least going to lock in some of my gains. The 20% rule is quite, it's not a rule, but I just kind of think you've got to have some point that you say, right, I've lost enough money and I better check that I've done it right. And I just said, look, I'm not that smart. I've got friends that say that, they can predict the share price within 5%. And I'm like, well, that seems to me to be a bit questionable. So, I just say, look, very often as a professional investor, you're at a big fund. The fund's got billions of dollars. You don't have that many positions. When you deploy capital, you're deploying capital in size. And if you're going to deploy capital in size and there's something wrong with a company because that's why it's underpriced, then you don't know where the bottom is. You can't wait until the bottom to buy, because once it's bottomed, if you start buying it, you'll just send the price up against you. You just can't get in. So you've got to buy it on the way down. And guess what? You might not get it within 20% of the bottom. So when it falls 20%, I then say, okay, have I made a mistake? And I then go back and I look at it and I really robustly check all the sell arguments, assuming it's a long. If it's a short and it goes 20% the wrong way, usually just cut it. Rare to top up a short. But, if you think this is, my original thesis is intact, my original target price is intact. Well, you've bought it at £1, thinking it was worth £1.50. It's now 80p. Well, if you don't buy more, you're really going to kick yourself. And so that's just the reason for that process. Because, I've now got a double, not a 50%. And that's really compelling. So you've got to buy more. It just forces you to question how committed you are. And I would do that as a matter of course. And I would write a new note. So it was almost like it's a fresh idea. It's 80p and the target is 150. But of course, that note would only go into the downside. It would only go into the risks. We're down 20%. This is not good, but I'm still confident in my thesis. And if it goes wrong, you're screwed, because you're going to get, you're allowed to make mistakes, right? So you lose 20%. That's not a big deal. It's not great, but but if you get it wrong when it's down 20%, then you've done a bad job.
Yeah, agreed. Could we talk about the training business, Steve? So I guess maybe tell us a bit about the business, what you do, who goes through the training, and then secondly, I'd be interested in your views on where you see the sort of biggest, let's call them skills shortages or sort of shortfalls with people going through your training. Where do you see the real sort of need is?
That's an interesting question. So my business got 3 legs to it. It's got a publishing leg. So I've got a podcast which goes out once a month. I've got a Substack which is free and paid, which I write for the paying subscribers weekly, and for the free subscribers 2 or 3 times a month. And I've got an online training school, which is 50-50 private professional investors. And my main product is the Analyst Academy course, which is basically everything you need to become a competent investor. And I designed it for private investors, but oddly, I had a fund manager in Canada say how much he was enjoying it, and this guy that's managing $500 million, he just wanted to, he just wanted to educate himself. He just wanted to say, is there anything that I can learn? And although he's a professional investor, he's professional. He's finding lots of things that he didn't know. And the main part of my business, and the thing that I spend the most amount of time on, is I train people in person. And so I do that physically in person or over Zoom. And I have this forensic accounting course, which I do in various formats for different types of clients. So one thing that we've done new this year, we've done it as a workshop. So I go in and I give people an example of a balance sheet, and they have to spot what's wrong. That's quite fun because what I do is I have a Slido and they have to enter what they think is the right answer. And you might have 10 people in the room and you might have 10 different answers. And they go, oh, hang on a second. Why have we got this gap? Usually what I do is I do it in 2 half days. I do it 1 week apart because a day of accounting is there's a lot of numbers, and the course has got between 150 and 200 different examples of accounting chicanery. So, it's a lot of information to take in. So it's better to split it up. And I go into the theory of how companies cheat, why they cheat, the signals that companies that are cheating give off, particularly fraudsters give off. And I go through the P&L, the balance sheet, and the cash flow statement, almost line by line, saying, when I look at the goodwill note, nobody looks at the goodwill note. Stupid, because there's lots of useful information in the goodwill note. Here's what you should look at. And it's been really, really popular. I mean, I did the first one in 2018, about 6 years ago now. I've trained, 800 plus people since. But and I also do, I've got a valuation course. I've got an introduction to accounts. I've got an introduction to analysis. And I basically do custom training. And I think what's unusual about it is that there aren't very many former practitioners doing this. So, I've been in that seat. I've got the scars, so I kind of know what people are going through. And the skills that are really, really missing are people just do not understand how to read a set of accounts. And I can tell you that, lots and lots of people that think they're very, very smart and very, very good cannot do a cash flow forecast to save their lives. They just do not know what they're doing. And that's true of the sell side, and it's true of lots of buy side. And if you think that the cash flow is meant to be the most important thing to look at, it amazes me that people don't understand. And they don't understand, some very, very basic concepts like the cash flow statement does not reconcile to the balance sheet. And if you're looking at a US company, it's actually very difficult to work out what's happened to the change in net debt. And most people don't even think about that. They think, oh, I've got the cash flow, I'm good.
When you talk about the fact that so many, perhaps especially younger analysts, don't read the accounts perhaps as much or as well as they should do you feel that's increasingly the case? Has that been a sort of trend in the last 10, 20 years?
Well, I think I put in the book, I forgot, it's so long since I wrote the book, I've forgotten what's in it, but I had somebody in the office the other day and they said, well, in the book you said that people don't read the accounts. And I've got all sorts of stats saying people don't read the accounts. I mean, the accounts are, it would be stupid to imagine that just reading the accounts would give you an information advantage, because how could that be possible in an ultra competitive world? But I don't believe that everybody reads it. Far from it. And obviously, there's fewer, active managers are really under pressure. Today the cost pressures are immense. And therefore, what do you do? Your most expensive resource is people. So you have fewer people, more junior people, and they have to cover more stocks. They've got less time, and you actually need more time. So, I think that the one discipline that people could introduce into their firms to really improve their performance would be spend more time reading the financial statements. But, it is not an easy thing to do. And it's a very time-consuming thing to do. And that's why, working with somebody like me who can improve the team's efficiency is really, really helpful. Because, if you can do it faster, if you know what you're looking for, then, your job's a lot easier.
Can I ask you about lessons from your long career, Steve? I guess both in your capacity as a sell-side analyst, buy-side analyst, and in what you do currently. So do you have, especially as it applies to younger analysts and sort of people earlier on in their careers, do you have 2 or 3 key lessons? I appreciate it's a very broad question, and this could relate to, the research process or investment philosophy or anything you like, or in other words, what sort of worked and what hasn't worked over your career? What kind of key points would you make to someone who's coming into the industry?
Well, I think the people are probably better today than they were when I started. People were very ill-disciplined about their use of time. And I think that's probably, people are more effective at their time management today. There's a great temptation. You're working in the stock market. You don't know what's going to happen every day. So why plan? And I think that's daft, because I used to be a management consultant before I started in the city. And, management consultant, you've got, 100 things that need to be achieved by the end of the week. So you've got to plan very, very carefully, particularly because you're doing a big project. All the steps are interlinked. So if you don't deliver, that causes a delay in the whole. So you're very cognizant about planning. And it's very easy to say, well, I don't know what's going to happen in the stock market tomorrow, so why plan? But actually, I think planning is very, very important. So that would be one thing: planning and time management. The second thing, obviously, would be just reading the financial statements. That there is so much information in there. I've got this exercise that I do with students, and I give them the balance sheet of a company just by percentage of assets, and I give them 8 ratios, and I say, well, tell me about this company. And I say, well, tell me what industry this is. And when I give this, people don't be, how could I do that? And it's amazing how much just that 20 numbers, what paint the picture that can paint. And I think people just don't spend enough time on the numbers. I know it sounds stupid because we're in a numbers oriented game, but just by looking at the numbers, and I think, putting the numbers before the narrative, because I think what you end up, people love stories, don't they? And so they tend to make the numbers fit the story. But if you start with the numbers, they have their own story and they can tell you what's really going on. So I think, much more emphasis on the numbers. And I do like this understanding what's in the share price. I think that is a really, really core skill. And it's not something that everybody can do, or it's not something that everybody does. It's something that everybody can do. And I would just spend more time thinking about, well, why is this stock this price? And understanding, does that mean there's an opportunity? I mean, you don't need to have a gap between perception and reality if you've got a good enough stock and it's not too expensive. But, to make money, the stock's got to do better than people think. Yeah.
I thought it was interesting what you said about reading the account, Steve, because I think you also say in the book that you know, when you build a model, for instance, you like manually actually punching the numbers in. I'm just the same, but when I you know, I every year I have a couple of interns over the summer, but I think increasingly they're used to downloading data right into an Excel file, and so I may ask them, what about the turnover growth rates you're telling me about? Are they organic numbers? And of course, often they wouldn't even be fully aware of you know, are they reported? Is there currency in there? Because you know, they haven't gone through the exercise of manually actually opening the annual report and you know, figuring out what the underlying or organic rates are, and they may not know what the adjustments are because they've just sort of taken a big file and downloaded it. So I totally agree with you there.
It's hard work though. I mean, and you know, I wouldn't necessarily do it for every year going back
Of course.
forever. I mean, I would always spend a lot of time thinking about the revenue growth and how it's been delivered. And then I would always look at, you know, this year, last year, maybe the year before, and put those numbers in by hand, just because it just makes you more familiar. You know, you're much more likely to spot something. But and it takes a bit of time, but I find it quite therapeutic. I'm probably quite sad, but you know, I just find you've got to do what works for you. I mean, I don't, you know, I'm not saying you can't. There are tools nowadays where people have already pre-checked the numbers, so you're just downloading something that somebody else has prepared, and that isn't necessarily a bad thing. It might be more efficient. You got to do what suits you, and obviously, some of the tools that are available today weren't available when I started in the sell side and started in the buy side. So you know, I might do it differently today, but I think if you change the way you do things, it's quite dangerous.
Yeah. And I also think some of these tools take you know, document search functionality that you see today, which means that you don't need to read through a transcript, but right, you can just look for certain words, and right, but you can sort of debate whether that's actually progress or not, right? Because there's a real value I find in actually manually going through all these documents and punching the numbers into a spreadsheet and what have you, right? So remains to be seen whether that is an improvement, whether that actually means people become better investors or more efficient investors or not.
Yeah, I mean, I think, you know, as with everything, there's kind of a balance, isn't there? I mean, if it's, you know, for me, if it's a stock that I own, then I want to listen to the call because I want to listen to the tone of voice. I know it's much quicker to read the transcript, and I'll read the transcript for the competitors' calls. But if I own it, you know, I think I can hear that there's a problem, and I don't want to miss that nuance. I mean, if it's a small position, I might not care as much and be happy to read the transcript. Or, you know, I've got a friend that does Chat GPT, or not Chat GPT, but a different AI. He feeds everything into it and gets it to summarize everything. And that, okay, I get that, but you've only got so much time in a day. You want to cover more ground, but you know, there comes a point where you're going to miss something, and you just got to work out what's the risk and how important is the stock to you. If a stock's important to you, shortcuts are dangerous.
Yeah. So so we covered lessons from your career, Steve. I also wanted to ask you about the investors that have had the biggest impact on you, or that you find the most impressive. You've obviously had a lot of very you know, interesting, impressive guests on the podcast. You work with a number of people at different, you know, on the sell and the buy side. And who have you, you know, are there two or three names that you can point to and say these people have had a real impact on the way I think about investing? Or are there two or three people that you can say these are the most sort of impressive characters I've come across in the industry?
Well, I mean, I've met lots of impressive people or observed lots of impressive people. And I mean, you know, I think it would be unfair to sort of single people are. We had dinner last night with Chris Bloomstrand, and Chris is a good friend of mine, and very serious, very straightforward. And one of the things that he's very keen on is sort of ethical behavior, and so that's something that I've kind of sort of put up my ranking list. Whereas before I was much more relaxed about we talked about investing with the crooks. I probably had I met Chris earlier in my career, I might have been less susceptible to taking that risk, because I think he would never invest with a crook, and obviously you've got to gauge what the risk is. But um, I, I'm not sure that I've worked with a load of different people. I've spent time with a load of different people, talking to people at conferences. If you're on the buy side and you're at a big successful hedge fund, people are interested in your views, and it's an easy route to talk to people. I've been, Marathon, Hosking Partners, these people, I think, genuinely did very original work on the capital cycle. Um, I've got a lot of respect for a number of the Tiger Cubs, where I think they've just done, somebody like Andreas Halvorsen is a very, very, I mean, when you talk to him, amazing. He's got an amazing understanding of the world and the environment in which he operates. And I've found that working with clients that when you start getting closer to them and understanding how they think and trying to help them in their process, you get a much greater insight than you do having a chat over lunch at a sell side conference or whatever. And the conversation I had with Stuart Roden on the podcast. So Stuart formerly used to be one of the co-managers of the Lansdowne Developed Markets Fund, which had an extraordinary performance, and they were my biggest client. And I'd known Stuart for 20 plus years, but having an hour conversation with him where I could ask him questions was just fascinating, because I knew he was really smart, but I hadn't gauged the degree. It's that, crikey, that is amazing. And people are they're good, but just that the ability to have that one-on-one conversation I found with the podcast has been fascinating. I had a very different experience, equally, almost life-changing, with Mr. Cowell, who is a man who went through 8 tragedies in his life and sort of bounced back. And when I interviewed him, statistically, he had 9 months left to live because he'd had cancer. And the cancer was 27 months old. And I said to him, Peter, you're the unluckiest person I've not just met, but I've ever heard of. And he said, well, actually, I think I'm quite fortunate. I live in a developed country. I'm reasonably well off. And he started to list what he was thankful for. And, I recorded that podcast, I know, 3 or 4 months ago. And almost every day since, I've thought about that guy. And I've thought, you know what, whatever problem I'm having today, it's not that big a deal. So your question was about investors. I mean, he's kind of an investor, but I think one of the things I think the podcast has been very interesting, because I've talked to people not just about investing but about life more broadly, and I've never kind of planned my life. I kind of just get up in the morning and do whatever I'm going to do. And some of these people that have planned their life and I really thought about what they want to achieve and what they want to make, how they want to make themselves happy and fulfilled and all the rest of it, I have a real admiration for that. I think it's not something that necessarily I would want to do today, but maybe if the younger me, if I'd been exposed to that, would have thought differently. So I think you can learn not just about investing, but more broadly, and that's been fascinating actually.
I think it's an excellent series of conversations, Steve. Very impressive guests, and I love the podcast, so I highly recommend that to anyone.
Well, thank you.
And what is the future plan then for yourself and also for the business if you look, 5 or 10 years ahead?
Well, to be alive, that'd be
yeah, that's a good plan.
If I have many more nights like last night, I mean,
Yes.
my life. But no, I think I don't. I've never kind of believed in having a strategic plan. I barely bother with a budget for the business. I can remember in the COVID period where my marketing people were going on at me. We need to have a sales budget so we can see how we're doing. And I came up with a budget, and they said, "Oh, but look, you've been growing like that. How can you?" And I said, "Well, I think that the growth has been fantastic, but I'm not going to extrapolate it because that's what analysts do, and that's very dangerous." And of course, I was right not to extrapolate. So I don't have any sort of grand plans, but I think for my business, the three legs of the business. So the in-person courses, what I want to do is I want to get much bigger in America. The American market is 10 times the size of the UK market for both professional and private investing. I reckon, roughly that sort of order of magnitude. And my US business and UK business are broadly equal across the business. I mean, it varies from channel to channel. And I think my US business should be much bigger. So I'm planning later this year to go to America and to actually do some training sessions. So, try and publicize what I do. And so, if I had an ambition in 5 or 10 years' time, would be to be bigger in America, bigger in Asia. The Asian education market is huge. I mean, I have a joint venture in Korea for the online school, so my content has been translated into Korean and is available on a Korean, one of these all-you-can-eat education platforms where you've got a subscription model. And but beyond that, my Asian presence is very, very low, and so I would like to grow that. But I don't have a strategic plan or anything like that. I'm my business it keeps me intellectually stimulated and gives me an income, but I'm not trying to grow a big business because I don't have that ambition for it. I would like it, I think you've got to try and grow because that's a challenge, but it's not like I want to have 100 people working for me because I could imagine nothing that would make me less happy. What makes me really happy is I've just done a course which we're giving away. So it's a free training course for young people who want to get a job in asset management. I've interviewed 3 young headhunters, one that specializes in private credit, one that specializes in private equity, and one that specializes in quoted equities. So we've done this course, which is how to get a job, whether you want to get a job. And because if you're thinking about quoted equities, you should also think about the other avenues. There's much more, it's really hard to get a job in quoted equities. And maybe even if your intention is to work in public markets, it might be easier to get a job in private markets first as a stepping stone because there's so much competition. So I thought that was a good way of doing it. And that gives me pleasure because I like creating the content. I think I'm helping young people to get, because what I've done as an analyst, it's been a fantastic job because it's been intellectually stimulating. It's been financially very rewarding. And I've just really, really enjoyed it. I want other people to have that same opportunity because I didn't, I ended up completely by accident. So I want to be an evangelist for financial analysis. And so we've done this free training course and I hope it helps lots of people. But, I'm doing it because I want to help people, but I'm also doing it because it's fun for me to do, fun for me to create this content. And and it's something that I'll keep adding to, because when I and it includes a load of stuff, very basic stuff about how to understand financial statements and that sort of thing, and how to behave in a job interview, things that I would have found helpful when I was starting out. But it also includes things like I was reading Roger Federer's commencement speech. I don't know if you read it. Not commencement speech. He was awarded an honorary degree at Duke University, and of course he didn't go to university. He's a professional tennis player. But man, that speech was amazing. It was hugely relevant to investors and hugely inspirational. I think, well, lots of young people never read that speech, right? Why would you? I was sent it, and I thought, God, this is fantastic. I'm going to share that. So when I'm sent stuff, I'm going to add it to the course. And hopefully, it'll be a resource for people, and hopefully it'll help them when they're going for that job interview.
That was great work, Steve. And then finally, if people want to engage with you, where and how should they go about it?
Well, my first obvious place is my website, behindthebalancesheet.com. There's a form there you can fill out to get in touch with me if you want to ask me something. I'm on Twitter very rarely these days because I hate the way it's been changed, because I don't get notified when people at me, and I do get notified when Elon says that's shit, or some completely uninteresting tweet. I seem to be a notification in my feed, but I do occasionally get on that, and I'm on LinkedIn.
Okay. Well, it's been super interesting to chat about the book and the business, Steve, and thank you for taking so generously of your time.
Oh, not at all. Thank you for asking me. I've enjoyed talking to you.
Likewise. All right. Thanks again, Steve.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.